Pillar 2, inflation. We call it the thief for a good reason. It silently eats away at the value of your money, making everything you buy more and more expensive. So when inflation gets too hot, a country's central bank, well, they have to step in and do something about it. And traders watch this stuff like a hawk. They're glued to reports like the CPI, the Consumer Price Index, trying to predict what the central bank is going to do next.
Next up, Pillar 3, GDP, or Gross Domestic Product. The absolute easiest way to think about this is as the country's final report card. It's the big number that measures all of its economic output. A healthy, growing economy, we're usually talking around 2 to 3% growth, that attracts foreign investment, which in turn strengthens its currency. A bad report card? Yep, it does the exact opposite.
And finally, Pillar 4, employment. This is the fuel for the whole economic engine. It's really simple when you think about it. If people have jobs, they have money. When they have money, they spend it. And when they spend money, companies grow, and the whole economy expands. This is exactly why reports like the U.S. non-farm payrolls, or NFP, are the undisputed heavyweight champions of market-moving news events.
So now that we kind of get the power behind these reports, let's talk about the danger zone. A lot of new traders, they try to trade right as the news is dropping. And let me be perfectly clear about this. This is financial suicide. Let's break down exactly why.
So why is it so deadly? Why does that picture-perfect technical setup just evaporate the second a report like NFP comes out? Well, it really boils down to two huge problems that happen in those critical seconds right around the news release. Problem number one, liquidity completely vanishes. In the seconds before a huge report, the big banks and financial institutions, the ones that provide most of the money in the market, they pull all their orders. They just step aside to protect themselves from the chaos. The entire pool of money in the market, it just dries up. Poof. And when that liquidity disappears, this is what happens. The spread, that's the little gap between the buy and sell price, it explodes. It can go from a totally normal 1 pip all the way to 20 pips or even more in an instant. And here's the crucial part. Your stop loss, the one you thought was protecting you, is now basically useless. The price can literally jump right over it without it ever having a chance to get triggered.
This crazy combination of no liquidity and insane spreads creates what we call the infamous whipsaw. The price will shoot violently in one direction, tricking traders into jumping on board, and then instantly reverse and crash in the other direction, stopping everyone out. It's a brutal trap, and it's designed to prey on amateurs.
So, how in the world do you escape this trap? Well, there's a simple, non-negotiable rule that professionals live by to avoid this exact nightmare scenario. This is your escape plan.
Here it is, the golden rule.